Good morning, good afternoon. Hey, so how is everyone? Our regular faces here, regular names. Sam is saying I was in a meetup with Kai yesterday in the office of the CEO. I don't know what is that, Sam? Morning, Nyanka. Good morning, Aditya. Morning. Okay, let me make sure that my audio settings are correct so that if you're saying anything, I can hear you. It says something. I just need to do a speaker check if my speaker is working connected to the right one or not. I can't hear anything if anyone is saying anything. All right. Oh, no. Oh, it's unmute. Okay, hold on. Uh, Okay, now let's try.
Hi, Vivek. Good morning.
Hey,
Is
good
everybody
morning.
good?
Okay, everything is good. Thank you for helping me testing
Good morning.
the speaker. Okay. Sometimes it does happen that the output of the sound is connected to external microphone and all that, and then I can't hear anything. Then I have to go back and change it. Uh,
So Monday, the CEO of Oracle is going to spend an hour or two with us. I just found that out because Hai-Fu Lee, you know who he is, right?
yeah,
He
yeah.
he just sent the website, and then after we saw it, we were just like this a meetup. Then I looked at their website. So these are real movers and shakers of Silicon Valley. And then Wednesday is some dude from the FCC.
Hmm. Okay. So you got to hear Safra
No,
Khan.
Monday.
She's a CEO of Oracle, right? Okay, cool. All right, maybe I will, but it's on. It was on Friday. Okay. So yeah, if you have a link for that meetup, yeah, if you can share, that would be great.
I put it up on the top, the email, so it's that website.
Oh, okay. Collectiveei.com. Gotcha.
So the early people get to see it, the late people don't.
Okay. Cool. What else? What anything else learned this week? What's the learnings for the week? We'll get to the regular markets, but let's figure out what else. Any new thing you guys did?
I,
I
I,
read the Invested book by Phil Town and his daughter. That was interesting book.
Which one?
Invested.
Oh, Invested.
Mhm.
Who's the author?
By Daniel Town and Phil Town.
Okay. Thank you. Yeah, I mean, I don't know who I was talking to. I think I was talking to my daughter yesterday, and I was like, it's so much better to read through the books or the newspapers to get the information rather than scrolling through the Twitter feed. But this whole social media bug, still I spend a lot of time on the Twitter, which I said I need to cut down on it because it's mostly the end result in terms of what I learn is uh, is not that effective, but it is engaging. So anyway, so yeah, good that at least you studied on that book. I'm a guilty. I don't think I read whole this week. I didn't read anything on the books that I have in progress. Bad me. Not a good job. Anyone else? I think Aditya, you were trying to say something.
yeah, I was just saying, I've been revisiting the options videos, and I just find them incredibly useful just to go back with the trades that I'm doing now.
Okay.
And so, yeah, thank you for those. And yeah, but books I've been reading, a different sort. So Stumbling on Happiness is a great book, but not exactly related to investing, but goes into the psychology of um, how a human brain can make mistakes and makes assumptions. So it might be useful, might not be useful, but yeah.
No, and by this time you probably would have known I am a big fan of psychology or emotional intelligence. I think that is way more important in investing than IQ. So yes, anything that keeps us grounded, it's a good book. Another book which I would, I think I read many years ago, which is called Biology.
Right.
Biology, which is around how marketers use, and I think that also applies to how these CNBCs and other financial channels, how they, what tactics do they employ to basically, sell us stuff. So I found that very interesting.
Right. Right.
Cool.
Yeah.
Right. I still have a book which is like work in progress. That's based on, I think its book is pretty old, but my who reminded me recently, so I took it out of my shelf and I said, okay, I'll start reading it. That's around whole can slim approach. Uh, those who are more of a traditional investor want to look at fundamentals, and I remember seeing this word for the first time in 2003. It's called CanSlim, and I think it's the founder of IBD, Investor Business Daily, or some group. So that's the book I started, but I think I've done only two chapters. The whole this week I didn't do anything, so hopefully uh, and some time to move on that book. 48 Laws of Power.
Yeah.
Interesting. Okay, let me take note of this. Cool.
And then my all-time favorite is Charlie Munger's talk on the psychology of human misjudgment.
Hmm.
I mean, it's just incredible. That one's just absolutely incredible.
Yeah, I have a PDF. I haven't gotten to that yet, but I've heard a
Wow.
lot of praise about um, that is his talk around the psychology of human misjudgment.
Yeah. So there's a YouTube talk on it. I can also share a link. So it's actually his recorded lecture at Harvard, I think.
Okay,
And it is literally the best of the lot that I've ever come across reading
yeah,
all the psychology books.
cool. All right. I think yesterday evening I came across. I'm a big fan of Howard Marks. So there was
Yeah.
one YouTube video I came across, which is almost and more than an hour long. If you guys are interested, I'll find that out. And basically, that's a compilation of his learnings. I mean, I like reading him because it talks about a lot of risk management, which is where we need to focus on. Ravish is saying, has anyone read option volatility and pricing? Not me. I mean, I kind of understand how the volatility impact pricing. Beyond that, since I'm not a okay. Oh, by Sheldon Nadenberg. But I heard Sheldon's talk in one of the option Greeks session by Tasty Trade. But I've not read Sheldon's book. I think I don't need to read that book because I'm not that deep into like I'm not a market maker on the options side, and I just use options to hedge my portfolio and reduce the cost basis. So anyway, anything new? So today, at least what I was thinking about for today's session was, of course, we'll go through in terms of how the markets have continued to defy any of the challenges that the economy or any numbers are thrown at him. So let me just share the document. There we go. Okay. Yeah. So markets continue to climb the wall of worry. We'll look at that. And And my favorite topic, which is, hey, sentiments or the analyst or the news, they always follow the price. So gonna look at how the sentiment is now starting to change around China. You know, Jan 2023, China is uninvestable. People, all the smart money pulling funds out of China. And now I am seeing in the newspapers or in the magazines or, financial media that, hey, China is great. So we're gonna talk a little bit about that. So I also spent this week in digging a little deeper into Alibaba. I mean, I hold Alibaba for a few years, but I wanted to go and understand. It's a big beyond retailing. It's also into a lot of other businesses. So I'll give you a little bit brief on
Vivek,
that one. Yeah,
Adam Koo, multimillionaire investor. He's
I
probably
know.
about your age. But he said Alibaba has an intrinsic value of 130. It's lost its monopoly. So he says that's why he's holding it to 130.
Okay.
I was thinking that now it's divided up, it has more opportunities.
So and I will share in terms of what's currently I think is priced into Alibaba's, mm, uh, you know, I'll get to the valuations. I do have some numbers also to share on Alibaba. Yeah, Adam Koo's maybe 130. I've seen different. Some says 145. So I do not tend to forecast in terms of what's the intrinsic value may be, because it is very difficult. You need to know what the future might imply. You need to understand everything about the business, not only the company's business, but also the competitors, also how the world around the Alibaba will change. I don't have a crystal ball. I don't think anyone have. So the traditional, you're discounting cash flow projection. I'm not a big fan of that. But what I do is what is market currently implying in terms of what's being priced in. And if I just go back at the history and say, can Alibaba continue to grow its cash flow at the pace as which it has grown, or make some adjustments? Then I'll say, okay, what's the pricing it comes out to be? So we're gonna look at that. So hold on your thoughts on Alibaba. What else? This is our first meeting after the end of the month. So I will give you update on what's on my portfolio. Right. There have been some changes. So we'll share that. Yes, that's it. Then some news, some analysis as usual. But yeah, those are the, I guess, main topics on my agenda. So I do have a hard stop. I have to leave home at around 12:30. So I have an alarm on my cell phone at 12:15. We'll probably spend 5 more minutes. Then I have to go. Okay. So if some of your questions don't get answered today, we'll take it up in our next week's session. Alrighty. Let's go. Any questions?
Sorry.
Yeah, go ahead, Neil.
Yeah. So you said you don't believe in a discounted cash flow to calculate the fair value. What model do you usually use, or which metrics do you follow to predict the fair value, current fair value?
Okay, I'll share anyway when I'll go through the valuation. I'll tell you, but I do the reverse of it. I'm a big fan of Charlie Munger says invert, always invert. If I cannot predict what the fair value would be, at least I can know what is market pricing in today's valuation. That's much easier to know, because I'm just looking at the current pricing. I'm looking at the cash flow and I'm saying, okay, what is market priced in based on how much of a cash flow growth has market priced into today's pricing, right? That's just math, but I don't have to predict anything about future, right? So that's called a reversing the problem. I'll just do a reverse discounted cash flow. And then if I say, hey, the market is pricing in only 1% growth, 2% growth, that doesn't seem to be correct, because, hey, look at the history. I mean, we did that PayPal, right? Last year when we did the PayPal, the only reason why I was bullish on PayPal was market was pricing in 2% growth in PayPal. Right? And if you look at their average free cash flow growth over last 5 years, 7 years, it was more than 2%. And also, hey, US economy grows generally at 2%. And I think PayPal can grow more than 2%. So that was my thesis. I did not have any information on what PayPal can do in future because they got a new CEO and he changed the company completely. Even if I would have tried to project it, I would have been horribly wrong. And he changed it for good, right? So that's the icing on a cake. Similarly, when we looked at Alibaba last year, when the whole China uninvestable, the smart money was leaving China, it was same concept that his free cash flow yield was 17% in one of the quarter where they had the release. I'm like, that seems to be no brainer. Of course, you have the regular risk of CCP, which is still there today. And market is pricing almost 0% growth in Alibaba. So I will do a reverse DCF to see. I have a today's pricing, which is what the current market price is. I have the free cash flow for the last 4 quarters or for the last 1 year. So both these are deterministic numbers. I just have to run a math to see what growth is market pricing. So I use that. To do the DCF, you need to project about the future. All investment bankers do it. I don't even have that information about what the company might be doing it in future. You can gather that from their quarterly reports, etc. But given that the business is changed so fast nowadays, I think it's a futile exercise to trying to project how much the company is going to earn for next 10 years and then beyond 10 years in eternity, right? No one could tell what, especially the companies in the tech, where they will be in next 10 years. Well, we have no idea. Who knew that ChatGPT will come in 2022 and change NVIDIA? Any valuation on NVIDIA in 2021, if anyone would have tried to do the valuation of NVIDIA at 2021, they have absolutely no idea that ChatGPT is going to change the whole future, not just for NVIDIA, but all the tech companies, right? So yeah, that's why it's a, I mean, you can put in a lot of assumptions, but then your valuation will be as good as your assumptions or as bad as your assumptions. All righty. Ramesh, glad to join after missing 2 weeks. Yeah, we're missing. I'm like, where did our regular crowd go? Where is our Michigan folks? Good to see you back. All right. Anyone joining here for the, I see a new name, Zena? Did I get your name correctly? It looks like a new name. Zena, you want to introduce yourself? What brings you here? How did you find this group? Okay. All right. Let's move on. Cool. As always, anything that we discuss here is not a financial or tax advice. We're just here to learn or maybe have a little bit of fun out here. Okay,
Sorry,
Zena, go ahead.
Hey, Vivek, sorry, I was unmute and it wasn't working for me. I'm sorry. This is not my first time. This is
Oh.
my second time. But very interesting.
Cool. Okay, so looks like I missed your name in some of the previous ones. So what brings you here to the group? What are you looking to get out of spending 2+ hours?
Yeah, so basically I'm starting with investments, and I'm kind of like trying to understand different strategies and how to actually diversify the market and how to look at it. So I'm kind of beginner.
Okay, cool. Got it. All right. So I think one for a beginner, if you're not, and of course we're just a beginner, someone may not be interested or haven't yet figured out how to analyze individual companies, stay with ETFs, broad-based, diversified ETFs. So that remind me, today morning, I just finished reading a report from Morningstar. So obviously it's not in today's document, but I will cover it in next week, which is called Mind the Gap, which talks about which shows you the empirical numerical data between the returns that a mutual fund has earned versus the returns that the investors in the mutual fund has earned, right? So pretty interesting study. All those who are swing traders, I think it will be an eye opener for those. So I will cover that report next week. But the quick takeaway, because Zena is here and she's new to investing, is if you're not pro, and I guess if you don't have inclination or a time to study individual companies, stick to broad-based, diversified index ETF, and that should do pretty well. I mean, SPY is up 20%. So even if you're, it doesn't need any college degree to invest in SPY. All right, SPY is up almost 21% for the year. So
yeah, I already started a small portfolio, so I'm not 100% like this is the first time I'm starting to create my portfolio, but I know a lot about trading. It's just I didn't have the guts to start.
First step is always the hardest step.
Yeah.
Cool. All right, Ramesh says, I reinvest the dividend every quarter. Yeah, DRIP, dividend reinvestment investing program. A lot of investors follow on the DRIP. That's also a type of investing strategy. Ross says, just heard about an interesting data point. Shares in float may not be what they seem due to thousands of ETFs that need to hold the underlying. Okay. Yeah, if you have is there an article, etc.? I'm always interested in how these market structure are. Yeah, we'll be interested to go through this. But one thing we all know is there are more ETFs than there are stocks available in the market. So every stock is probably in multiple ETFs. All right. So let's get into today's session. Let's start with what's happened in the market, right? Markets continue to climb the wall of worry. Getting into the fourth quarter, so third quarter, end of September, getting into the fourth one, there are four main things that market was worried about. One is recession fears, right? The labor market. This happened after some of the numbers, the job numbers were revised downwards by some 800K, right? And I was like ranting that how can these PhDs can't get their job correctly, that every month they have to come and make such a big revision. That was a shocking revision, and the market puked on that revision. So obviously there was some recession fears saying, hey, if labor market is broken, and that is why Fed also did a higher than usual rate cut of 50 basis points. So that was one. The other one was tensions going in Middle East. Third one was strike by port workers. These are basically Gulf and the East Coast port workers, longshoremen, workers. And finally, the fourth one, which is still there, is US presidential elections, right? So these are the four main, I would say, topics or areas where market was a little worried about. So let's look at each one of them. How did labor perform?
Sorry to interrupt. Are you sharing something?
I am. It does say me that screen is shared.
I can see it.
Okay. All right. So at least got confirmation someone can see it. So maybe rejoin or something.
Okay, let me try that. I'm not able to see anything. I can just see you.
So if you're on multiple monitors, maybe the screen share has gone into the different monitor. I've seen that happening sometimes.
Oh, is it? Okay, let me rejoin.
Okay. Ross says port worker. Yeah, I'm gonna talk about that. I'm gonna talk about. There was an interesting interview of the what do you call the chairman or of the head of that union. So let's first talk about labor. So Friday, labor payroll rose 254K, which was the most in 6 months. I don't think market was expecting that. So that was, a little bit of relief from a recession. Maybe we are not getting into recession. Maybe we have achieved a soft landing. So whatever Fed was doing probably will work out. Annual wage growth also picked up to 4%. Not only that, the number of the employed people was more than expected, but even the wage growth also picked up. That's hourly wage growth. And then the unemployment rate fell down to 4.1%, right? Which is almost at a full employment. So this is like overall the employment situation, right? The sector specific could still be is a different discussion. Tech sector is still reeling under the impact of layoffs, so that sector is still tight. But overall, US unemployment rate is like 4.1%, pretty close to full employment, right? If you look at the numbers were all good. The figures also showed that the fewer Americans were working part-time for economic reasons. Right. So it means if we want to work full time, they were able to find a work. People who lost the job recently were able to find other jobs, right? So market is celebrating that. Underemployment rate, which includes those who are working part time, that also fell 7.7%, right? So all great when it comes to the employment numbers. Right? Just one caveat in the report was people unemployed for 27 weeks or longer. That was the highest of 2022. Maybe they don't want to go back to job for whatever reason, But overall, the jobs report was pretty good on Friday, right? My only worry is how much of this will be revised in later months, because we have seen the numbers being revised every month. They'll go back and revise the previous numbers. Now, after having been burnt a couple of times, especially last time when it was revised by 800K, I'm a little bit skeptical. We'll see how much it gets revised. But also election is coming up. Maybe there will not be any revision. Right? So a little bit of the politics may be involved. Not that I'm implying anything, but it is possible. So on labor side, all good. Port workers, they reach a tentative deal, right? Which is what Ross is talking about. But what pissed me off was the interview that chief negotiator, sorry, he was a chief negotiator, Harold Daggett did on, I don't know which channel was it, but when that interview, it exploded on X. And I'll not go through the whole interview, but this is something that I want to read through it in terms of what he talked about the strike, right? So he explained what will transpire when the workers will go on strike at the ports across the East and the Gulf Coast of the US, right? These people don't know what the strike is. These people means Americans, the American citizens. They don't know what the strike is. When my men hit the street from Maine to Texas, every single port locked down. You know what's going to happen? I'll tell you. First week, it'll be all over the news every night. Boom, boom. Second week, guys who can't sell cars, guys who sell cars can't sell cars because the cars ain't coming off the ships. They get laid off. Third week, malls are closing down. They can't get the goods from China. They can't sell clothes. They can't do this. Everything in United States come on a ship. They go out of business. Construction workers get laid off because the materials aren't coming in. Steel is not coming in. Lumber is not coming in. They lose their job. Everybody is hating the longshoremen now because now they realize how important our jobs are. Right? And I think somewhere he mentioned, I'll cripple you. I don't think I have that, and that was oh yeah, that was a headline, right? I'll cripple you, and you have no idea what that means. Nobody does.
Vivek,
So, yeah, go ahead.
ports in the U.S. are BS. You know, we get them checked out in Shanghai, Hong Kong, and Singapore. So they check if there's illegal drugs and all that. We don't have automation here. That's the issue. They don't want automation.
Yeah. So that's the one part of the negotiation. And, of course, they were demanding, I think, 70% increase in wages for in next 6 years. The ports, they had offered 50%, and I think now they've agreed to 62% increase in wages in next 6 years. 6 years. It's an interim settlement. But more importantly, one of the demand is not to automate, even for the semi-automation. So I don't think, so that's where the whole Twitter was blown up. I've seen people, some folks commenting saying, I work in industrial automation. I'm willing to contribute 20 hours per week to automate the port so that these people don't, keep us hostage next time, right? And then the the citizen journalism became active, and then they tried to dig into the assets of Harold Daggett, in terms of what he owns. And he drives a Bentley and recently sold his 76-foot yacht. He earned almost 900K last year, and Elon was commenting, oh, this dude has more yachts, than me. This was yesterday. Basically, a table around how much each of these negotiators, or what I call heads of unions, have earned. He's on the top, close to 900K. Anyway, so currently the sentiment around Harold Daggett has been pretty negative, but as a negotiator, I would say he did his job. Right? He's able to, I would say, keep America hostage or economy hostage, and was able to get close to 70% or 60% hike in wages for next 6 years. So I think kind of he earned, but I think all the businesses are saying, hey, we need to figure something else out so that we can't be kept as hostage, in future. But anyway, so I guess he earned his 900K. That's all. But so there is an agreement that has happened for a wage of 62% over next 6 years, rising average wages from $39 per hour to $63 per hour over the life of the contract, right? So I guess this is an interim settlement that they have reached, and I don't know when's the next negotiation is gonna be. Ramesh is the election drama. Ross, who cares what Daggett earns? He got the workers a high pay. Yeah, that's why he looks like he earned his 900K. He earned his 900K because he got the workers higher wages. Now, businesses and those are impacted probably will crave, but it is business, right? Both the parties are trying to extract the best out of the current situation. Second wall of worry was so I think the strike only lasted for 2 days, so it did not have much impact on economy. I think JP Morgan had done a study saying per day impact is $5 billion. So there was a little bit worried that if the strike continues for a long time, you would see the shelves are going empty in supermarkets, and all the goods that can't move because of the containers can't get off the ship, and that would give rise to inflation. That didn't happen. So strike was there for 2 days, I guess, right? Wasn't it delayed to 125? Yeah, there is. I know it's an interim settlement. Yeah, so I didn't know that it's now delayed to January. So maybe until January, we'll see after the election who comes in. So I think right now, probably kick the can down the road and we'll worry about it later. Second wall of worry was tensions in Middle East. I don't think that's completely diffused yet. So we had Israel had bombed Lebanon, killing Hezbollah chief. Iran that fired 200 missiles on Israel, and now we have a ground offensive going on. You know, Biden had mentioned that Israel shouldn't touch Iran nuclear facilities, and Israel like, I don't listen to you. You know, we gotta do what we gotta do. So I think that we still have that tension going on in Middle East, and that's led to the crude prices jumping from this is the crude futures had some decent run up after the tension. Again, crude prices have not performed this year because of China's economy, weak economy, and outlook of weak economy from China. But just because of the tension in the Middle East, we saw crude futures spiking higher. And I don't know. I don't think it's that we. I mean, if the situation becomes worse and someone starts a nuclear war, I think the portfolio will be the last thing to worry about it, right? Till then, I think it's maybe a short-term spike on crude oil. In any case, the commodities have been very depressed, so maybe it is just catching up. So that was the second. Third one is our that's a third one. The last one is US presidential elections. So we have less than 5 weeks to go for the final date of elections. And like we have seen in previous elections, the volatility generally spikes up in run-up to the elections. In the long term, elections don't matter. Whether it is red or a blue, doesn't really matter who occupies the White House. Stocks generally tend to do well, and they've done well under both the parties. But if you're focused on what might happen in next 5 weeks, be prepared for a little more volatility in the market. Historically, we have seen that. Now, maybe Fed gonna do another cut in the interest rate that may, tame down some of that volatility or the movement on the downside. So there could be some impact because of that. But in a long term, really doesn't matter, right? So election, no election, whether it's Kamala going to, occupy White House or it's going to be Trump, I think short-term markets may move up or down based on who is in. Long-term really doesn't matter. I think businesses will continue to do. At the end of the day, stock market will follow the business in the long term. And if American businesses continue to do well, and so the stock market should just follow it. So I'm not too much worried, but this is something which is still there. So these are like 4 big wall of worries. I guess Middle East is still a little uncertain. I don't know what's happened like yesterday or latest one, but other than that, I think everything else is nothing but good. Ross says time to short US. So I'm not shorting anything. I just added a covered call to my short put that I had on XLE. So one good thing is that when market spiked up, I was able to close my short put for October at profit. And then I added another one for November expiration. And Friday, I added a covered call against the short put. So now I have a strangle on XLE. I don't like to I've not shorted USO. USO is based on futures, so it's not really based on, if my understanding is correct. I don't think USO is based on spot oil prices. I think it's based on future. So there's a little bit of that nuance involved in USO. So I'm not, I mean, I used to do options on USO, I guess, well, 3 years or prior. I don't think I've done on USO after COVID. I've just stuck to XLE, but I have traded USO earlier in my option days. Corporate owned media pushes nonsense news in order to divert attention from the matters that matter. Yeah, I don't even know how much we can trust mainstream media. You're right. I think it's nowadays I'm always skeptical. Okay, here's a link if you want us to study to hear. Okay, mind the gap. Yeah, I'm gonna cover this mind the gap next week. She shared USO. Okay, yes, it does use derivatives as future contracts. Cool. So next topic is around sentiment that's now changing around China, right? It's always the case and that is why it is. I just don't use any financial media or any smart money to make a decision on your investment, because I have seen time and time again is that it's the narrative always follows the price. The moment you see the stock going to $100, every analyst will start to give a new price targets closer to that. Dude, give me a price target of $100 before it goes to $100. Post facto, who cares? It's already over there, right? So now, after bashing China for more than a year, after the institutional investors have withdrawn almost $3 trillion from China, after scores of articles around how the Chinese market, which is true, the Chinese market, before 2 weeks, went nowhere in last 5 years. After interviews and interviews of how China is uninvestable, now just in a week, things have changed. Narrative has started to change around China, right? And of course, it's all driven by the Chinese bazooka that we discussed in our previous week's session. I'm not going to go through the details of bazooka again. Only thing I added was a part one, because Chinese government may not be done yet. So there is a possibility that if the economy doesn't improve, they may come up with a part two of bazooka, right? Other thing was, apart from just giving a fiscal and the financial aid, I think they are already also assuring a lot of private businesses that, hey, we understand the importance of private businesses and we would want to help them to grow. They got a direct support from central bank for institutional investors to invest in stock and for companies to do buyback and all that. So I posted this on Twitter. There are months when nothing happens, which is what was related to China, and then there are days when everything has happened. Right, last 1 week, now Chinese large cap market measured by FXI, which is ETF, had underperformed SPY for most of the year. So if you compare between FXI and SPY, it will FXI has been underperforming SPY for most of the years. Let me get that out. Let's put a SPY. SPY compared to FXI year to date, right? It's been underperforming. So blue is SPY, yellow is FXI, except a month in between, it's been underperforming. And now, last 2 weeks, FX is up 48%, Basically, FXI is up 48% year to date, and your SPY is up close to 21%. Right, 2 weeks the tables have turned. Right, so I think it was overreaction because a lot of institutional investors, they were not only that they exited China, they were also short on China. So like short China, long Max 7 became a new favorite trade. So there was an article on FT that most foreign investors were still underweight, and short or negative with China was the second most crowded trade, just behind getting long on Max 7. Right? So if you really look at how these Chinese ETFs or individual stocks have performed, like this rocket ship, pick anyone. K-Web, which is internet ETF. So FXI is your large cap, includes everything. K-Web is basically internet ETF, was like $26 on 23rd of September. Now it's at $38. Right? Pick other companies, Baba. Similarly, JD is even higher. All these skyscrapers and rocket ships, PDD, same case. So why? Because now those shorts are maybe getting squeezed, right? So maybe this is a short squeeze. Investors had pulled out $4.2 billion out of these ETFs and the mutual funds that trade on US, but invest in companies that are domiciled in China and Hong Kong and Taiwan until the end of August. Right. So from a start of a year till the end of August, 4.2 billion have been taken out of those mutual funds and the ETFs, right? So those fund managers now got to do some explanation. And now that they suddenly realize that they are far, underperforming, or that their strategy has backfired, right? So yeah, this was a chart I was showing that FXI is up like 48%. Okay, that was like chart I took on Thursday. Year to date, FXI is up like 53%. Right? Now, how in the hell you gonna explain to your investor saying, I pulled out of a China right before it exploded to 53% year to date gains, right? So, yeah, these are like in 2 weeks, the tables have turned. So what happened? What's happening now? Everybody is now trying to say, hey, China is good, right? Deutsche Bank went bullish on China. This time it could be different. And again, I'm not suggesting that this is going to continue or this is right or wrong. All I'm trying to say is, hey, narrative follows a price. So don't get caught up in the narratives. If you are investing in China, and I think whenever I picked up Alibaba, I told I'm picking up Alibaba, but I understand the risk. And I'm not gone, even though it is the most undervalued company that I hold in my portfolio, I couldn't add more to it because of the position size rule that I have to follow. But I didn't sell it out just because the narrative saying China is uninvestable. I would rather control the risk using the position size. Right? And just reduce the cost basis. So, and then this came in, I don't know, I forgot which newspaper was it. So bank became bullish. Investment firms are now saying, just do it, right? They are buying Chinese securities. In August, even though the profits of industrial giants have dropped 18% year over year, and I think that's what kind of a spooked Beijing into taking this whole bazooka into the extreme measure of injecting liquidity. And now the so-called smart money, and now, I don't know, they're trying to chase the gains in China. UBS says last week was a clear turning point for the China A-share market. Right? After bashing Chinese market for 6 months, now it's a clear turning point. Now the UBS is raising its its target on China, right? For Hang Seng Index by 7%. Nomura Holdings, this is a Japanese company. Japan's biggest brokerage, Nomura, similarly increased its year-end target for MSCI China to 65 from 59. Right? Texas Municipal Retirement System, right? I do think in the next 10 to 15 years, there's just going to be a lot of equity value created across Chinese companies. One of the big PE firms, private equity firms, Partners Group from Swiss, we are contemplating very seriously setting up local renminbi denominated fund. Narrative follows the price. Now, when the pricing, when the Chinese equities are through the roof, I'm seeing institutional investors, fund managers, smart money. Now they figure out changing the narrative and saying, oh, I think there's a structural change happening in China. I don't know. And that's why I don't want to even forecast what's happened. I just look at the companies that I own, what's the risk to the company versus what's the business that these companies have been doing. And I still own all my Chinese stock, and I'm with 100% knowing the risk that it is still CCP. Right? So the CCP was there in last year also, or at the start of the year. The same CCP is still there in power in China. So what has changed from risk perspective? All the pundits that were calling China uninvestable because of CCP, how CCP changed its mind, how CCP was going against their own businesses, how CCP is fickle, you can't depend on them. Nothing has changed. That same CCP is still there. But now, because for temporarily, the Chinese markets are outperforming, you see all the positive narratives now coming out from China. Again, you got to do your own homework, understand what you hold. Another interesting one, if you sold some Chinese equities because of all the negative narrative, you're not the only one. Walmart sold 140, almost 145 million JD shares at 25 bucks. Now that is trading at almost 47 bucks, just in 2 weeks. Global investment firm Process sold 14.5 million shares of Trip.com at 51. Now that is trading at 70. Baidu also missed gains. So overall, early exits, because you exited, you wanted to invest somewhere else because China was becoming uninvestable. China is risky. You can't explain it to your LPs why you're investing in China, where there is a US geopolitical tension going along, around on that. The opportunity cost of exiting China is $3.3 billion. I won't be surprised. Now, if we see smart money talking, picking up positions in China, because now they're trying to chase it. Okay. Are we done with it? No. I think I still want to see the structural change in Chinese economy before I think of increasing my position size in Chinese stock. I'm still holding to the position that I have had before this, spike up. I'm not added any more capital. I didn't bring in any more capital into Chinese stock, but yeah, I didn't sell off. I had my covered call spread on Baba. Yeah, it was a spread because I still want to hold it for longer term. So that covered call spread now is in the money. I'll probably sell some shares of Baba and hold the rest of it. Right. Same is the case with other Chinese stocks that I hold. Naresh says, all my Chinese covered call didn't defend. You can't defend such moves, right? These are like so-called, um, 5 delta moves or 1 delta, 2 delta, black swan kind of a moves that happen. FXI up like 53% year to date, whereas it was almost did nothing for the rest of the rest, prior to that. Like country ETF, I can understand individual stock going up 30%, 40% in 2 weeks. Have seen many of them. But a country ETFs going up 30%, 40% in 2 weeks, that doesn't happen often. So you just only way to protect against these so-called black swan movements is to control your position sizing. I had, because I always want to reduce my cost basis, I had a call spread on Baba. Now that is completely in the money, but thank God I did only call spread. Right? I have covered calls on my EVs that I hold, but then I didn't do covered calls against all of my positions. I did it on, the parcel of the stocks that I own. There's no way I can defend it. Even I'll try to defend it, but you can gather some of few pennies here and there. Well, let it go and I'll enjoy the ride with the rest of the shares that I hold. Right? Maybe I'll sell another covered call at a higher price. Because I think this is crazy. Eventually, it should come back down, but who knows how long will this stay, right? So I spent some more time on Alibaba. So I want to go through the Alibaba and what businesses they have. Meanwhile, if you have any questions on Chinese stocks, shoot. Bobby says, do you still own the Chinese stock? Yeah, I mean, I've always owned. I mean, if I sell, I'll come and talk about it. What did I sell this week, right? So yeah, I still own all my Chinese stocks that I have in portfolio.
Vivek,
Go ahead.
my friends are not happy in Shanghai or Hong Kong. But I look on the news, they have news, of course, China downturn or in bad shape. But then you see tourist videos, news tourism videos that they're still traveling. So you kind of wonder what's going on.
So
is this a top 5% traveling, or is this because like I said, I have middle to slightly upper middle class friends, and in Shanghai they're not doing well.
yeah, so that's what I'm saying. So this stimulus has corrected the stock market. So I think Chinese stock market had lost $6 trillion worth of value, and I think last 2 or 3 years. Now it recovered almost $3 trillion. So stocks, it is still down, but I don't think it has yet percolated into the real economy, which is what I would want to see. Right? So you're absolutely right. The economy of China and the Chinese citizens are still being constrained. I mean, the property prices are still down. The government has done this bazooka to help them out, but the impact will take time for the impact to be seen. So I'm not surprised when you say that, hey, your friends or families in China, they are still not happy because the economy is not doing well, which is right. So the stimulus has so far helped the stock market. We have yet to see the effect of it percolating into the real economy, right? So I would rather wait for a few more months to see what numbers come out, or how the real economy improves through this measure, right? If it is not going to make any structural change, then this is a short-term gamble that has happened, right? But it is also true that after seeing what's happened in this equity market, lot of maybe little younger investors in China and in Hong Kong have been thronging to brokerage firms to open brokerage accounts. So the online brokerage account websites started to crash. They were working 24/7. So, you know, the investors, the individual investor, they're starting going to the branches of the, little not so, like, how I should put it, like the equivalent of chawl shops, not Robinhood's, because the Robinhood's equivalent sites were crashing, and these were open to go ahead and open an account in a little older brokerage houses and all that, because now there is a FOMO going around in among the investors, those who are not invested, even the local Chinese and Hong Kong investors, those who have moved out of the market, and now they're seeing that the prices of the stocks are ripping through the roof. So there is some FOMO going around there. Brokerage firms have been working 24/7 to open accounts. So these things never, so these movements that we see, movements of these magnitude generally don't end well, right? But so I'm a little cautious on based on, I really want to see if there is a structural change that happens in the economy. Aditya, did you discuss tools or no? We did not. I did not put the recording. Yeah, this week I was very busy, so I did not have the recording up yet. So probably I'll do both of them together. But no, we talked the regular stuff last week. How is the market outlook for long-term bonds? I don't know. Only thing I know is the Fed is going to cut the interest rates, then your long duration bonds will go up in value. That's just basic math, right? And if market starts to think that the Fed may not cut the interest rates, then the bonds should not perform. So TLT, right? TLT is come down. I don't know. This is maybe because of inflation worries, or now the labor market is strong. Is Fed gonna do 25 basis points instead of 50 basis points? If that's the case, then the bond will not perform. But long term, we're not gonna stay at like 475 basis points for next 10 years, right? Maybe we'll come down and settle at 200 basis points. Probably we're not going to go back to zero. So, but maybe 2%. So when that 2%, then the TLT should still recover. I mean, if you look at TLT, it's been a brutal ride ever since Fed has started to increase the interest rates in 2022. It's been just going down. But if Fed starts to go back and reduce the interest rate, I should see this going higher. Beyond that, I don't have much idea on what's going to happen on bonds. Wasn't China market closed last week due to Golden Week? Yeah, so Chinese stock market is closed, but US stock market is still open. So all these FXI and all these equities, which I was saying, is all the ADRs or the ETFs that trade on US market. And it is surprising, the second biggest economy, exchanges can just shut down for a week and go on holiday. Everyone goes out on holiday. The business is shut down. Even the stock market shut down. Oh, that's crazy. All right, let's look at Alibaba.
Oh, excuse me. Can I contact on their 8-day weeks, their 9-day weeks? Actually, the workers only get around 4 days off in accumulation because they work on the other weeks they work Saturday and Sunday. So 3 days off because they work Saturday and Sunday for the 2 weeks before that.
Gotcha. Okay. No, I mean, I would love to have this wherein you can have a block of a week holiday. I think in Europe also they do at some particular, because I remember in summer when I was talking to European customers, they're like, nothing new gonna happen. No one is gonna sign a new contract because they are all out in summer. And then my team members in China, they'll suddenly disappear for a week. And so we knew that, hey, this week, nothing much will happen on China. because there's a golden week. I would love to have that in US, wherein, hey, let's work maybe an extra day or Saturdays for these 2 weeks, and let's get the whole week off. Right. So I would love to do that way rather than just taking 2 days off. Anyway, so let's talk about Alibaba. uh, Alibaba, I think I don't think it needs an introduction kind of stuff, but let's go through small history, and then I will come back to the business segments of Alibaba, then the numbers. Okay. So founded in 1999 in a small apartment by 18 people. That's probably the most number of initial founders that I've seen in any company. 18 people, of course, led by English teacher Jack Ma, who became a legend in Chinese business community. Collected $25 million funding. That was the initial funding from Goldman Sachs and Fidelity. Initially, it was founded at B2B e-commerce, so from business to business, marketplace, and then moved into business to commerce, then commerce, so consumer to consumer, more like an eBay, which is Taobao. In 2003, 2004, created Alipay, which is to manage all the payments. 2009, Alibaba Cloud came in. 2013, gosh, I realize that I've been saying this horribly wrong. It's called Jianhao. Jianyao. You guys need to correct me. That I've been talking about, and I'm not going to pronounce it again, but I guess I got to understand that the right
Jian Yao.
Jianhao. Okay.
Jianyao. Sorry, my which accent is wrong, but it's Jian Yao, not yeah.
Okay, yeah. So that's what I got to know. Now this is a logistics arm. So now they've connected business to commerce. Business to business. You have a consumer to consumer. You also have a business to consumer. Now you build your own logistics network. 2014 launched Tmall, which is business to consumer. 2014, Alipay became Ant Financial. 2017, increased the stake in the Xianhao to 64%. Stocks, Alibaba, if you go back at the history of the Baba stock, it's been a roller coaster ride. Like hit $320 when there was a anticipation of, let me just get rid of these two, don't show, anticipation of IPO of Alipay, right? That Alipay IPO will probably, if I recall, the whole valuation of Alipay itself was maybe close to 300 or $400 billion, right? So in run up to that IPO, the Alibaba stock was almost $300. And then we know, Chinese government, they scuttled the IPO. And since then, the stock went in a tailspin. Some of it's Alibaba's fault. Majority of it is not Alibaba's fault. The overall market sold on Chinese stocks. Chinese government became more hostile against the accumulation of wealth by private individuals or private companies. They started to tighten the regulations on the tech industry. We saw what they did to Didi, Alibaba, JD.com, bringing case against all of these companies. There was an official antitrust investigation into Alibaba, and that resulted in the first financial fine against the regulatory crackdown against these tech industries, right? And then, so there was a lot of, I would say, the Chinese government, the actions of the Chinese government were not helpful to the big private businesses, especially on the tech side, because the government thought that these tech companies are exercising too much control, are having the monopoly, and government wanted to distribute the wealth. So we have seen cases Jack Ma kind of disappeared. for many months and had to be educated about the values of values that was promoted by CCP and all that stuff. And then on the US side, we started to see more concerns around, hey, these stocks that we own really are not really doesn't give you any operational control on the companies, right? If I own a stock in Meta, I have a say in the operations of Meta, however small that say may be, right? But if I own a stock of Baba, I have a zero say in the operations of Baba, because the way the Chinese stocks get listed onto US is through VIE, which is variable interest entities. Not gonna get into the details. That's we covered about VIEs when it blew up in the media. Say, hey, you're not holding, you don't have any operational control, which is true. I mean, that risk is still there. And the idea was Chinese government could ban this whole VIE structure anytime, and then US investors will be left holding the bag. That risk is still there. I'm not saying that risk has disappeared. The risk is still there. Fund managers, which are more concerned with their career risk rather than an investment risk, they pulled out of Chinese market, right? So, which again led to a depressed stock prices because everyone is pulling out of market. Now, understand where the fund managers are coming from. In Wall Street, if you are a money manager, you are a fund manager. If the term career risk means if your rest of the peers, other fund managers, if you underperform other fund managers, then you're sure to gonna get fired. So for me as a fund manager to save my job, I just have to make sure that I don't underperform the other fund managers. It doesn't really mean that I have to make money on my investments, right? As an individual investor, and that's why sometimes I say, as an individual investor, we are better than institutional or fund managers because we don't have to compete with anyone else. We can just focus on doing investments that will give us best returns. Right? Fund managers don't get much. I mean, if you try to go and chart your own path, you try to go against the herd, you try to go against what everyone else is doing. And for whatever reason, if that doesn't work out, it's a hell for you. So no fund manager wants to take that risk. So you'll see the herd mentality. If one is selling, everyone starts to sell. Because if, as a fund manager, if I had held on to Chinese stocks, where everyone else is selling, and Chinese stocks don't perform, or if they underperform, I'm going to get fired. If everyone is selling Chinese stock and everyone is underperforming, I still have my job. So who cares? I just have to make sure I stay, at the same level as my peers. If everyone is getting F grade, I'm okay to get an F grade. But as an investor, you don't benefit if your fund manager getting F grade. You eventually want to see the return. So, concerned with the career risk, every fund manager pulled out of a Chinese market, worsening their stock price. So that's what's happening on the price of Alibaba. So let's look at this was interesting because, I mean, when I was tracking the earning results of Alibaba, I knew in terms of the overall big segments, but what I didn't know is how many companies underneath each business segment does Alibaba own, right? So they have overall these 6 segments that Alibaba operates. One is e-commerce, which is in China, Taobao, Tmall, 1688, which is like and then this is not a segment, this is just a tool. So Taobao, Tmall are the major ones. Then they have a cloud intelligence. which is Alibaba's cloud. Majority of the Chinese companies host their data with Alibaba Cloud because of geopolitical tension between US and China. It is the fourth largest cloud provider behind AWS is number one, Azure is number two, Google is number three, Alibaba Cloud is number four, right? Within China, it's at 39% of overall cloud market, with Huawei is number two with 19%. Tencent is number three with 16% market share. So in China, three big cloud players are Alibaba Cloud, Huawei, and Tencent. Okay. Third business segment is e-commerce outside of China, right? Which is called International Digital Commerce Group. You got AliExpress, which is a global retail e-commerce platform. Then you got individual e-commerce platforms in specific areas. You got Trendyol, which focuses on Turkey, Lazada, which focuses on Southeast Asia. So I've seen the references of Lazada while reviewing the earnings for C Limited and Coupang, because Lazada competes with both these companies. Both these other companies are in Southeast Asia. Duraz, which is in operations in Pakistan, Bangladesh, Sri Lanka, Nepal. Miravia, which is in Spain. So these are the B2C, and then there is a whole B2B commerce, which is the flagship Alibaba.com. This is how Alibaba started its journey in 1999, right? Which is in 190 countries and regions, basically B2B commerce. So that's around international digital commerce. There are a few more. We already talked about their logistics network, which is now Jianhao, which is helping them to do global 5-day and 10-day deliveries, right? Anywhere, I think in China, within China, they've been able to achieve 1 day, but anywhere in the world, they are able to now deliver in 5 days. It was founded in 2013.
Excuse me, Vivek.
Yeah.
It's 4 hours.
In China?
Yeah, that was a decade ago. 4 hours.
Cool. It's like a quick commerce, like I see in India. Then they have a
That's why, excuse me. That's why they have the high-speed rail. They could go from farm to house in very quickly. Very quickly.
Cool. Then you got another local services group, which is called Ellie.me, which is a on-demand delivery platform. I think this is probably what they acquired in 2018 to do this home delivery in these quick commerce. Then they have AMAP, which is a provider of digital map and navigation and real-time information in China to other companies. Digital media and entertainment group. So this is Youku, which is kind of equivalent of YouTube. And then you got Alibaba Pictures. They produce his movies. Then Demai, which is a live event service provider, e-ticketing, event ticketing. I guess it's equivalent to Live Nation in US. So these are the different business segments that Alibaba has and operates in, right? So it's not just e-commerce, it is already well known for e-commerce. I guess everyone knows Alibaba as an e-commerce platform, but it is moved beyond e-commerce, just like Amazon. Kind of you can draw some parallels between Amazon and Alibaba. Amazon got AWS, Alibaba got Alibaba Cloud, Amazon got Amazon Prime Video, it's got a Youku and Alibaba Pictures. Amazon has its own they don't have a separate brand, but they have their own Fulfilled by Amazon network, which is their logistics. Alibaba had Jianhao. Yeah. You can draw these parallels between now these are like conglomerates. And then they have some other stuff which I didn't even get into, some other businesses, probably too small, that they don't even break out their revenue on within these. Right? So that's big Alibaba. Now let's look at their numbers. Where did the numbers go? Okay, yeah, let's look at the numbers. So I looked at today morning, I picked up all the numbers. So as you know, I want to look at, is it a high quality business before I go into the valuation? So looking at, okay, these numbers. Gross margin close to 1 year, 3 year, 5 year average is close to 40%. Still the biggest portion is a retailing. So I'm still okay to see 30-40% gross margin on a retailing company. If you go back and look at last 10 years, 12 years of gross margins, on an average, those have been better over the last 10, 12 years. So something in the last 5 years, Alibaba had to spend a lot. That has dragged down their gross margins, right? 3% dividend yield. They've been buying back shares over last like 5 year, last 1 year, they bought back 3.5% of their shares. Alibaba still have, I'll probably cover more when they announce the earnings, but they still have $25 billion allocated for share buyback. They've been buying their shares like crazy over last 2 years because the share price was so depressed. The best return that a company can give to their investors in terms of capital allocation is to buy back the shares when they're trading below their intrinsic value, right? So they've been buying back their shares like crazy. Average operating margin, 10%, 12%, pretty good for retailer. Amazon has 9% operating margins, right? Revenue growth. And no surprise, the last 2-3 years average CAGR is 9% only. Right? And we know what's been happening in China for the last 3 years. Economy, property issues, Chinese consumers are not feeling that optimistic about the economy. So when you're not optimistic, you're not going to spend much. So it's difficult when the economy itself is down, it's difficult for the biggest retailer to grow, right? So 9% growth, if you expand beyond, last few years, overall average over a longer period, it seems to be pretty fine. Right? Free cash flow, look at the free cash flow yield, and that's been generating, right? Because of the depressed share prices, the free cash flow yield over the last 1 year is now on average 11%. In some, and I know we talked about it in some of when the Alibaba share was trading at $70, free cash flow yield has jumped out to 17%. I've never seen any other companies do that. So while the stock price was beaten, some of the business numbers were still looking okay. That's where you have to differentiate between the narrative and the business. Follow the business, not the stock price. Yeah. So from a number side, all fine. Obviously, it comes with a risk that government can change its stance tomorrow. So how do you control that risk? By controlling your position size. Alibaba was, some of the Chinese stocks were undervalued as a whole, not just Alibaba, not the individual stock, but overall Chinese equities were undervalued as compared to US in 2021. 2021, all the unprofitable companies of US, that whole November 2021 mania that we had seen when the US market was just going crazy after the stimulus. Chinese market, on the other hand, they didn't get that stimulus, was available at much cheaper valuation at that point of a time. And then it became further cheaper. Right? But you had the same risk that we have it today it's CCP, which can change the course of Chinese businesses at its own whim. They declared private tutoring as kind of illegal, and all the tutoring company shares just crashed 80%. Right? That risk is still there. So make sure your position size is corresponding to the amount of risk that you can take in China. So no, at a certain price point, businesses become attractive. Right? But I'm not going to back up my farm or back up my truck onto Chinese equities because I still have the CCP risk. But I won't pull out completely, because if I keep my position size fine, if it goes down to zero, yeah, I'll still survive. I'll be okay. So from that perspective, let's look at a valuation. What do I see? So last free cash flow for the past 4 quarters, almost $20 billion. I'm looking at a free cash flow for last 5 years. Their CAGR growth is 8%. Analysts are projecting on an average for next 5 years, revenue growing at almost 7.29%, EPS growing at 21%. Revenue over the last 5 years have actually grown at a CAGR of 20%, whereas the market capitalization has gone down 17% CAGR. That itself tell you that market is kind of a given these companies for that. So I just looked at and went to saying, let's assume, if I assume that free cash flow growth over the next 10 years going to be only 8%, which is equivalent to what it has done over the last 5 years, means, and we know over the last 5 years, 3 years have been pretty bad for Chinese economy. Right? So I'm taking kind of almost the worst case scenario. I'm assuming that because it is Chinese company, I want to have a much higher discount rate. So generally for a companies, you use a discount rate of 8 to 12%, because that's a kind of a return I want to have at minimum if I'm investing in individual companies. Now for Baba, I go to the extreme of, okay, I want a minimum 12% return, right? That's the discount at which I'm going to discount the future cash flow. The value is like $142. So my price point for China, Alibaba would be, I think, if $140 is the fair value based on free cash flow growing at 8%, and I'm demanding 12% as a discount rate. If we find that Chinese government has become more benevolent, government is doing structural changes and is promising the rest of the world that they're not going to be finicky about how they change their mind, instead of 12%, maybe I'll be okay with a 10% return, because now the risk is less. Then it'll probably be more than $140, right? So I'm still, I'll hold my shares and probably will continue to do trade options around the existing position. But I think earlier someone asked, what's the fair value that you are thinking? So I'm thinking based on what Alibaba had done in the past, and adding the discount rate that appropriately reflect the risk, which I'm looking at, maybe $140 is a price that comes out to be. Right? Again, no one knows the future. What if they now say, we want, they have a much more competition than what they have faced in last 5 years, then the numbers will change. But it does give you some idea of, start to think about the numbers, right? So yeah, $140 is where I'm looking at. Is Baba still cheap at 22 PE? I don't want to look at PE, because your E could vary based on a lot of factors. That's an accounting profit. I'm not a big fan of PE, but let's look at where it is trading on price to free cash flow or other metrics. So let's pull out Baba. Where's what are the other metric shows? There we go. PE is 30, current PE, price to free cash flow 14, which means almost 7% free cash flow yield. I'll do it. I'll do it anytime. Okay, price to operating cash flow, which actually reflect the business, 11, not that expensive. Right? And even if it is 22 PE, it is still, I guess, cheaper than SPY. If you're a fan of PE, Pisheng, it is still cheaper than SPY. But I will look at its free cash flow, which is price to free cash flow is 14.82. Look at March 31. This is where it was trading at close to 16 or 14, 15% free cash flow yield. Now it is down to, because the price has gone higher, now it is down to 7%, still better. So I think I'm still 140 is what I'm thinking should be. Does that mean I'm not doing any covered call right now? No, I'm still doing it, because if the stock is undervalued, doesn't mean market is gonna reprice it immediately. Or if the stock is overvalued, doesn't mean that market is gonna, sell the stock next week. Stocks can stay underpriced and overpriced, or markets can stay irrational longer than what you could have imagined. So I'm still gonna trade on both sides of the market. Do an iron condor on Baba, try to reduce the cost basis. Will you please share a fall for estimated intrinsic value? Yeah, I can. Yeah, I can share that. Again, this is based on, so from a math perspective, what this all does, it will pick up the free cash flow for the past 4 quarters. It will add 8% growth year over year for the next 10 years. Will come out to the free cash flow at the end of 10 years. Then you start growing it at 4% for, I think, next 20 years is what I've taken, right? So then you find out what's the total cash flow at the end of 30 years is, discount it to at a 12%, then what's the current free cash flow value is, and then you divide by the overall number of shares, you come out to this number. But I'll share the formula. Okay, so that's where I'm looking at 140 on Alibaba. So I'm not still selling. Now if it gets to 160, let's say it gets to 160, maybe I'll sell 25% of my portfolio, 30% of my portfolio, right? But I probably might still hold, or maybe I'd become a little more aggressive in selling covered call, sell at 30 delta instead of selling at 16 delta. Right? So that's a decision you can make based on what your understanding of the business and its valuation is. And let's say we get a new quarterly result from Alibaba and we review it, and I find, hey, the business has improved. Then my valuation doing the reverse discount is probably going to improve. Right? Then I'll come up with a new number. Question: when you sell covered call, what delta are you using? I don't aim at 80%. So again, this depends on how bullish or bearish on, and why am I doing covered call? So let's say in the stock in which my only motive is to reduce the cost basis and still want to hold for long term, maybe I'll do 16 delta, 20 delta, right? And if the stock is really undervalued, like Alibaba, which I feel was really undervalued, then I'll do a spread, because I don't know when the market is trying to reprice it, right? Then I don't want to be left out of the future gains. So in the that's why on Alibaba I have a call spread, not just a call, but generally I will do 16 to 20 delta if only thing I'm trying to do is reduce the cost basis. If I'm not too bullish on the shares, or I think those are fairly valued, then I'll go to 30 delta, 35 deltas. So that's all. I'll pick up the deltas. All right, so that covers up our Chinese what happened, whole narrative around China and Alibaba. Getting back to US, unless there are questions. All right, 1 week performance overall.
Vivek, last question about the valuation. So the last column is analyst average growth estimation. Do you particularly follow some analyst, or this is
No,
just
this is the average. I think the website picks up the however many analysts actually are giving the estimates, and then they average it out in terms of what's the average value is for each year, right? For, let's say, 5-year projection is 2025, 26, 27, 28, 29. So I just average all of them out and say, okay, this is what the analyst, those who are following it, is expecting it to be.
I see. And this is from stock analysis.
Yeah, I think Yahoo Finance will also provide that.
Okay.
So, I mean, this just gives me an idea of, am I thinking like picking 8% free cash flow growth? Am I too far off? If the company can grow its revenue by 7% and their earnings by 20%, and if you look at the recent history of Alibaba, they've been able to grow their free cash flow at more than their net earnings, right? So their free cash flow conversion ratio, which I tell you free cash flow divided by your earnings, is more than 100%, because it looks like they have a lot of expenses which are non-cash expenses. So from that perspective, growing earnings at 20% and I'm considering free cash flow growth at 8% is pretty conservative. And I'm going conservative because of the whole risk around China, right? So it just helps me to know, maybe I'm not too far off what the overall market is thinking about it. Okay.
Thank you.
Alrighty. So market is back to where it was a week ago. This is where we were a week ago, and now we're back there. So nothing much changed in the market, even though because we've gone through these 4 days, downtrend, and then suddenly jumped up on Friday. Looks like pretty good week, but nah. On an average, we are back to where we were a week ago. So nothing much has changed. Sector-wise, yeah, like more than 20% year-to-date return on SPY. What else could you ask for? Don't have to go any crazy. Don't have to pick any sectors. In the study, Mind the Gap will review. The gap is more in the sector fund. So if you're really, not yet a mature investor, you're a new one, just hold SPY, right, for US. You've still done pretty good. 10-year is grown almost doubled in 10 years. Oh no, 3 times, right? It's 200% up in 10 years. How long can we wait on the sidelines to think, oh my gosh, I think the market is risky? If you're investing for the long term, best time to invest was yesterday. Second best time to invest is today. So 20% year-over-year return. This is on top of 26% last year. But now, given what's happened on Friday, previous week we were here. This week, the dial has moved to almost to the extreme greed. And these are the short-term movements that happen. No recession fear. Everyone has now got the license. So fear and greed index is now to the extreme of a greed. So I'm cautious for a short durations, right? So I lost a lot of deltas on Friday because the market went higher. And then I'm like, okay, I'm not going to add any more delta. Right? I think 20% year-to-date gain is good enough for me personally. I don't know about you, but I'm personally happy with if market is up 20% year-to-date, that gain is good enough. I don't have to be too greedy and not trying to chase when it's going higher. So if market continues to go higher, I'll probably lag the market perfectly fine. Now, all I'm trying to do is to manage the risk in my portfolio, that if market starts to lose steam, I should be losing less than what the market will lose. Okay? So I'm going to manage my delta appropriately. I'm not going to add too much of a delta when the market is now trading in an extreme greed zone, right? Contrarian approach. I don't have to, become too greedy. And I'm fine with it. I won't be able to come and brag about how did I make 60% return this year, and that's perfectly fine with me. I just don't want to risk my portfolio. Okay, so
Vivek, I have a question.
go ahead.
So, what is the source of this this indicator?
It's on a CNN. I think I'd shared it in earlier.
Okay. No, what I mean is what usually they take to come up
Yeah,
with
so
that.
all on that page, they actually have a composition. They look at 7 different factors, market momentum. There are 7 and that combined, and that's why I like it, because it looks at various factors, right? And then come up with this. I've been looking at this for now 4 years, ever since we started this session, 4.5 years. And I think more than once I plotted this along with SPY returns. And when it actually goes in the extreme greed, the returns on SPY in a short term over the next few weeks is not that great. So kind of you have to stick to some indicator to become comfortable with that. So now kind of I become comfortable that when it is on extreme greed, yeah, don't become crazy. Don't try to chase it. It doesn't
Okay.
well in a short term.
Is it a good strategy to sell when it goes to extreme greed and then buy when it comes to fear?
Yeah. So here's the thing. When it goes down, you always end up into thinking, oh, it go down further and I'll wait. And we never end up buying, and then the market reverse. So I don't sell when it goes to extreme greed.
Oh, okay.
But I cut down on my bullish thesis, right? So if I'm selling a put, and if it has an extreme greed, probably I'll sell 16 delta put rather than selling normal 30 delta put. So that's all I'll focus on, not gaining a lot more deltas when it is at an extreme greed level. Right.
No, thank you.
Yeah, but if you try to sell it, I'm trying to time the market, which I haven't been able to do it. I don't think many people have been able to do it. Just doesn't work. Just doesn't work. Mentally, if you sell it now, it falls down further. Before you buy it, you'll say, oh my gosh, it's gonna fall down more. Maybe I'll buy it. I'll wait when it bottoms out. And we've never been able to find the bottom. So I don't try to do that. Okay. Yeah. So it looks at market momentum, stock price strength, breadth, put and call options, volatility, safe haven demand, what's happening on the bond side, what's happening on the junk bond side, then combine to see what's the sentiment happening in the market.
Okay.
All right, quick portfolio updates. Again, not an advice, but because we talk about stocks, I want to be transparent. I bought QQQ, I bought SPY this week. If you recall, previous week I had a short calls assigned. So I was a short on these at a cash, and now I'm trying to cover those short positions. Bought Mercado Libre, filled up the tank. I had to sell Mercado Libre when my call spread was in the money September, mid of September, when the stock was around 2,200. So now the stock was 1950 or whatever, somewhere near that. I bought that position back, filled up my tank. Nothing other than I didn't sell anything. I just, even though it's now at extreme greed, I don't know. I don't want to sell it now and gain a capital gain. So whenever you're trying to sell, please also understand the taxation. If you are holding, if you have a short-term gain, you're subject to whatever your taxable slab would be. Let's say if it is 25%. Do you think the stock is going to go lower than 25%? Right? Then why sell? Because anyway, I have to now give that 25% to IRS. I have a less money to reinvest later on. So that's why I don't sell it. I'll just pare down on my bullish sentiment, or maybe I'll sell a call spread against my position. Still holding Melly. Still holding. So I never had a short Melly. I closed my Melly call spread because it has a tendency to get assigned sooner. I had closed the call spread and I sold Melly shares in mid of September. So now I've just bought those shares that I sold to fill the tank. But I don't have any short Melly position. Otherwise, I would have come and shared saying, hey, I had to sell whole of the Melly because the call spread was completely known, but I had sold some. Ramesh, you say market does what market wants. It's like chasing a tail. Yeah, exactly. Don't try to chase the market or outsmart the market. No one has been able to. What's the saying? They say there are bold investors and there are old investors. There are no bold and old investors. Right? If you're bold, you can try to outsmart the market maybe once, twice. Well, you'll not survive in the market. You're an old investor means you're old, not, of course, not in terms of biological age, but how old for how long you've been in the market. You'll probably not be outsmarting the market. You'll not be in the top percentile, top decile of the fund managers in terms of returns. God never took any bold decisions, right? But you'll stay long enough the market to enjoy the gains. There are no bold and old investors. I don't know who said it, but it's it's very appropriate saying. So don't try to think that you figured out what markets does. Okay, so here's the top, I would say 15 positions in the market. Nothing much has changed. QQQ fell out of top 15 because I had a short shares, so that reduces my overall stock position and bumped up the cash position. So that's why you see cash became 8% and QQQ fell out of top 15. And this is as of end of September. So now I added some QQQ and SPY back over this week. So for latest one, probably QQQ is back into top 15, right? No other overall change in the leaderboard. All the stocks that were top 15 by end of August are still top 15 by end of September. Maybe relative positions have changed. I think Palantir has moved up to top 10 now. And now probably has moved even further because the stock is continues to go higher. Cash jumped to number 2. Yeah, because I had a short call assignments in QQQ and SPY. So cash position increased. And then the QQQ and SPY relative positions have decreased. So that's it. That's overall portfolio. We'll come and show the portfolio at end of October. Again, under that, any questions on portfolio? Not a recommendation. Don't go and buy Melly or Apple or Meta because, hey, these are my top positions. Investing is very, very, very personal, right? I am a type of investor who's comfortable with the risk. I'm comfortable in tracking Melly, etc. So I'm holding it. If you can't, these are volatile stuff also, right? Well, SPY is good enough.
You hold any short positions, Vivek?
QQQ and SPY.
But you bought them, you said.
Not fully. I haven't covered it fully.
Okay.
Yeah, I haven't covered it fully. So I probably still have short positions in QQQ and SPY.
So what does that mean, Vivek?
That means I have a negative shares in my portfolio. Means if SPY goes higher,
okay,
that I'm going to lose money on SPY, but my rest of the portfolio go higher. That's why I'm still holding it. Same is the QQQ. I had sold a call against it that got assigned because I forgot that they'd be gonna giving a dividend, and some of the calls were so in the money that the amount of a dividend was more than the extrinsic value. I mean, the stuff that we talked about early assignment, right? I didn't track it, so I got assigned, which is okay. My portfolio can hold it, those short positions. So I'm still holding some of the short position, I cover it, let's say, when the market went down on Thursday or wherever, right? So when I looked at, I think SPY was 569 in between this week when I picked up, I covered a little bit of it. QQQ, I covered a little bit when it was 579 or something, but I still hold a short position. And then, of course, I have a lot of naked calls against QQQ and SPY. So if market continues to go higher, I'll probably underperform, which is fine with me.
Vivek, can you talk a little bit about selling? I mean, a lot of people, they talk more about buying, but selling is also important, right? I mean, when is the right time to sell? I mean, you also mentioned about the tax. You should be aware of the tax thing as well. So, when is the right time to sell, and at what profit you need to sell?
I don't have a profit target. So
Mhm.
remind me. Okay, I'll me take a note of this next week. I'll probably point you out to one session where we covered reasons to sell and why I would sell. Price only if it is an egregious valuation, which is when I will sell. Let's say, like said, like for Alibaba goes to 160,
Mhm.
I might sell some portion of it, right? Otherwise, when I invest in a stock, I'm investing in as if I'm going to hold it forever.
Okay. But if the stock is not performing in that
If the
case,
business is performing, I'll still hold it. I don't focus on what the stock price is doing as long as if I continue to see the business is performing, I'll do it. So there are reasons on when I will sell the stock, right?
Mm.
One of the reason is business has deteriorated. My thesis was busted. Management, there is an accounting irregularities. Financial information not filed in time.
Okay.
I did this stock investment because I wanted to, my target was that, to buy a car. Now the stock is appreciated and I want to enjoy the gains because I want to buy a car. Yeah, that in that case I will sell it. Right. So to basically achieve that, what I had intended to. But just because price has gone up 5%, it's not egregiously overvalued, I'm not going to sell it.
Okay.
Right. So yeah, remind me, I'll keep I'll point you to a video where we talked about buying the stock, holding so this was like before buying the stock, what as an investor we should do, because stock investing is not the first step. You have to make sure others' life is set up so that you can stay invested in the stock. So pre-investing checklist, during investing checklist, once you bought the stock, then at least what I do, how I focus on reducing the cost basis, and then when to divorce it. So I kind of took it through as a relationship, dating, marrying, stay married, and then reasons to divorce. So I covered all that. I think took us 2 sessions. So maybe I'll point you out to that.
Yeah, that would be great. Thanks. Thanks so much.
Cool. All right. Earnings next week. Financials will kick off the earnings season. So we'll have a Wells Fargo, BlackRock, and JP Morgan. Generally, they'll set a tone, especially JP Morgan. Jamie Dimon will give us some insight into how the economy is doing and what he thinks the economy is going to do it. Other than that, I'm not much interested in anyone for the next week. I never knew there's a stock called Helen of Troy. That was a little interesting to know. Okay. Yeah, but I think Wells Fargo, JP Morgan, they'll BNY Mellon, they'll kick it off. Bank 7. Yeah, so these, I guess by the time, maybe it's a week after next or a week later when a lot of the stocks that I own will start to report earnings. So I guess next 3-4 weeks, we'll get back to a lot of earning stuff. Ramesh, QQQ versus VOO price difference. Why invest in QQQ? Or is I do QQQ and SPY because the options are liquid, and I think Sri already said that's the reason. QQQ and SPY because they're pretty liquid. VOO, you don't have that options on VO are not liquid. So let's look at November. Right. Look at the bid-ask spread. Too huge, too huge. SPY, you got a penny wide bid-ask spread. So, but if you're not in options, a lot of my friends just do VO, which is perfectly fine. Nothing against it. That's perfectly fine. I just do SPY because it is more liquid. And if you are more adventurous like Sri, is just like buy VOO, but do options on QQQ and SPY. So one of the factors I look at when I'm trying to pick up ETF A versus ETF B is also, is it optionable? Where do you have a more liquidity? Because then it gives me ability to reduce the cost basis of my holdings, right? So that's one factor that, I mean, if you're only stock investor, you don't have to worry about it. Then you can pick up whichever is the least expense ratio. In some cases, maybe I'm okay to pay a little higher expense ratio just because it's more liquid in options. And I probably can reduce my cost basis by anywhere between 5% to 15% per year by trading options around my stock position, right? Then I'm okay to pay 20 basis points of extra fee, of 10 basis points of extra fee. So that you have to figure it out. All right, what else? Let's talk about some companies. Let me just go to one new IPO. Then we'll come back to Amazon and all. Two things. Let's talk about OpenAI, and then there is a new IPO coming in. So I did put it on my LinkedIn. Maybe I should do more on LinkedIn. I generally don't do stuff on LinkedIn. I don't know, for whatever reason that day I thought, okay, let me put it on LinkedIn. OpenAI. So OpenAI had raised $6.6 billion and it was all over the news in recent funding that have now valued OpenAI at $157 billion. Very eye-popping valuation. Why not? Because it's a company that gave birth to all AI frenzy. That is what made NVIDIA worth where it is. So who all invested in OpenAI? SoftBank, $500 million. Sometimes I feel that when you see SoftBank investing such a huge amount, probably you're already near the top, if not at the top. Okay, that doesn't mean that the AI story is going to crash tomorrow. Okay, markets can stay irrational longer than your portfolio can stay solvent. So no, never ever try to think that you're smarter than market. So, but you know, the reasoning behind this is now SoftBank has a huge amount that they need to deploy, right? Deploying 10 million, 15 million, 100 million doesn't cut the ice for them. They need to deploy $1 billion, $500 million. So they are looking for the companies that can take on so much of a funding. And generally, those companies would be at a stage wherein they've already become much bigger, right? So, and then of course, we have, if 2021 has taught us anything, that was a whole pump, which was done by Vision Fund, where they've invested billions of dollars in WAG and WeWork and a lot of unprofitable companies. But that's his style. Like Masayoshi-san like to play big. That's kind of investor he is. Right? And he has lost his net worth more than 50% multiple times. But he's okay with that. So SoftBank invested $500 million, Thrive Capital $1.3 billion, Microsoft $750 million on top of whatever $13-14 billion that Microsoft had invested in OpenAI in 2022 or early 2023. I mean, that investment is now has returned multiple fold for Microsoft on paper, right? Microsoft got 49% stake in OpenAI maybe at a cost of, I think it was less than $20 billion, right? Now, that means the overall valuation of OpenAI was what, $40 billion? Now it is being valued at $157 billion, almost 4 times return on investment for Microsoft, whichever venture arm is investing in it. So they added another $750 million. Cotu, Altimeter, Tiger Global, $250 million each. Today morning, in one of the podcasts, I realized that ARC Venture Funds, Cathy Wood Venture Fund, has also invested $250 million in OpenAI. I didn't see that on Bloomberg reporting, but today morning I got to know. Others who invested are Khosla, not Khalsa Ventures. Jeez. Okay, I need to fix this. Fidelity, MGS, Quiet Capital. Who was absent? Apple. Apple had earlier, there were rumors that Apple is going to invest $6 billion. But when OpenAI had changed its restructured the company from being non-profit, now we're going to be 100% profit-oriented. 3 top people quit, then Apple pulled back from investing in it. So they didn't invest. Along with this equity, they also had a $4 billion of debt financing. These are convertible. I think there are convertible shares that they issued to banks in Europe. European banks are generally conservative banks, but they also want to get their piece of pie when everyone is having fun with AI. So they gave almost $4 billion to Sam Altman, even though this company, from any valuation metric, it has no profits, no EBITDA, etc. But banks still did it. So I guess maybe the FOMO is now spread to European banks also. OpenAI expected to lose $5 billion on a revenue of $3.7 billion in 2024, but the revenue is expected to be $11.6 billion in 2025, right? Crazy growth. This is a company came out in end of 2022, and we're already talking about more than $10 billion in revenue in 3 years, 2023, 2024, 2025. Probably the fastest $10 billion revenue in the history. I don't know about Google. Maybe Google did it $10 billion in 3 years. Maybe I'll have to go back and check it. Right? But not many companies would have grown revenue at the pace at which OpenAI has grown. Right? Another interesting aspect, it has asked the investors not to invest in Safe Superintelligence, XAI, Anthropic, Perplexity, and Glean. Right? For obvious reasons like SSI, Anthropic, Perplexity, all founded by some either the folks who worked with Saul and Altman had a fallout, started other companies, or these are the direct competitors because they all are doing a similar stuff what OpenAI is doing, right? So makes sense that you tell investor don't invest in that. Generally, VCs would not invest in competitive companies, but there are very few cases where I've seen company coming and telling VCs don't do it. It's a kind of an unwritten rule. If you invested in Sequoia, invested in Uber, Benchmark invested in Uber, is not going to invest in Lyft. Right? But I think Uber will come and say, hey, don't invest in Lyft, don't invest in Waymo. But OpenAI openly, unintended, asking the investors not to invest in these. What I didn't invest was what did Glean. Glean, I've used Glean product, pretty neat product. It doesn't build AI models. What beef did Sam has with Glean? I don't know, but I guess it validates the value proposition of Glean. So clearly, OpenAI wants to create a similar solutions for enterprise, which Glean has, which is enterprise search across your complete network of whichever files, emails, Slack messages, PPTs, documents, Notion, any medium that you use for capturing your information. Glean is able to find that out, and maybe now they'll be infusing OpenAI, the generative AI to ask questions. You don't even know what you're searching for, but you have some context around it. For example, I may not realize that it was Alibaba that I discussed, right? So if I search for Alibaba, Glean will bring up all the references of Alibaba. But now I don't recall what's the name of that company. It was some obscure company. All I know is that the company actually deals in some e-commerce in East Asia, right? So maybe using generative AI, Glean will allow you to, and I have not used that product for more than a year now. Maybe they'll infusing generative AI so that we can ask questions without giving them an exact term that you're searching for. It will figure out. And maybe OpenAI wants to do the same stuff, right? So anyway, so that's OpenAI, $157 billion. Damn. Now the companies are raising money, staying private at 100. When Stripe was what value, $90 billion was the maximum valuation, and everybody was crazy that, my God, $90 billion and still private. Then of course came SpaceX. Now we are seeing companies privately valued at like $160 billion. Unthinkable. What is happening, right? I don't know, call it AI mania, call it AI bubble, but interesting chart when you talk about bubble. Is it 2000? So Max 7 of 2000 versus, 20 versus the previous 2000 tech bubble leaders. These are the Max 7s. These companies are different, but I don't know whether these times are different. These companies are different in terms of, their PE, because I mean, this chart has a PE, but even if you do your operating cash flows or free cash flows, I don't think number going to be much different. So 2000 tech bubbles, Cisco 100 at PE, 17% net profit margin. Some of these companies are big cash generator. But that's why I still have some of these are my biggest holdings, even though sometimes I feel that, oh gosh, are we looking at 2000 again? But these companies are of different breed. The times have changed in terms of how much they can capture, how much cash they can generate. Net profit margin like 35%, 34%. And all of these companies, Microsoft, Apple, Nvidia, not Amazon, Alphabet, Meta, generate tons of cash flows. So we can't bucket them into the same as what IBM was or Lucent was or Nortel was. So while there are some similarities into what's happening right now versus what has happened in 2000, there are some differences as well. Again, market is smarter than all of us. So I'm not going to make any snap judgment. As long as business are still good, it is not egregiously valued, I'm still going to hold them. IBM stock is going up. I think IBM hit a new all-time high, or was it a 52-week high? I think probably it hit new all-time high. Look at this stuff. But what's the story around IBM? So, I mean, I don't know. I mean, what have they done in recent times that market should be proud of IBM? Probably they have the customers that are logged into those mainframes and haven't yet figured out how to move away from mainframes and have to pay up through their nose to IBM to maintain them. I don't know. Let's look at. I've not owned IBM, and I've never looked at IBM. But let's see. What's IBM's numbers are. Not expensive. What's their margins? It looks like. Oh, let's go to income side of the house. 16% operating margins, 13% profit margins. Yeah, why would I not invest in, let's say, Microsoft, etc.? But I don't understand the story behind IBM. Let's pull up if we can IBM investor relation. How do they make money? Is it more on services, more on products? I've never gone into the details of IBM. Let's say oh, come on. Let me just see if I can PDF. Do they give a breakup of their services? Oh, to see. My thinking is, bro, they are making a lot of money from from a consulting side rather than developing great products. I don't know if they actually. Let's do one thing. Maybe I'll spend some time on IBM, and then let me take a note on IBM review, because you're right, it doesn't get much of a mind share or air time, but the stock has hit new all-time high, right? There's something cooking, and if they have actually have done some good work in terms of new tech, etc., maybe I'll be happy to look at it. But if it is that they made revenue by squeezing their customers who just can't go anywhere because they don't have option, then you're just hoping that some of their competitors are not able to come up with a migration plan. I think they're investing in AI consulting. So yeah, that's a consulting business. I'm thinking if they've done anything on producing something good. So anyway, we'll go to IBM maybe next week. So that was around OpenAI and generally AI. Let's talk about Tesla. Tesla did their Q3 deliveries, which is 462,000, whatever. It is a little less than the street expectations. Not too less, but a little less. But good thing was it increased year over year. After being negative over the last few quarters, we saw actually a quarterly increase in number of deliveries, which you can look at it both ways. Either the delivery numbers, you can say hey, it was better than what they had internally assumed, and it has increased quarter over quarter after being negative for past few quarters. That's a positive sign. Or you can look at, hey, the analysts were expecting it to be 463 900 and it did not deliver. That's not a good sign. I don't know, market could look at short term either case. But if you want to do more than what you did last year, then Tesla has to sell 515,000 vehicles in Q4. So which seems to be a little bit a stretch. We'll see, because right now analysts are predicting 485,000. So it means maybe overall yearly deliveries probably will still lag last year. And then I saw a Cybertruck prices reduced to 80K. And I think the bullish thesis currently on Tesla is their 1010 robo-taxi event. We don't know what is going to show us, but the expectation is they're going to probably show us some form of a robo-taxi, which you can just pick and drop in any place and will drive by on its own. But right now, I think that's what is making market bullish about Tesla is their, of course, Cybertruck deliveries and maybe the robo-taxi. If the robo-taxi doesn't pan out, I don't know. Elon Musk will find another narrative. One is which is, hey, autonomy. But this is a stock that gets moved a lot more by sentiment than by what's happening in the business actually. But that's other thing which was it actually got a more favorable treatment from EU. So EU had imposed additional tariff. This was on Friday on Chinese EV. So SAIC, Geely's, BYD. So there is already a 10% tariff. Added another 35% on SAIC. Tesla got only 7.8%. So overall, much favorable treatment from EU in terms of additional tariffs. So my alarm went off. So that's a reminder. We should stop. I can hang around another 5 minutes. Then I have to leave to attend a birthday party. Right. Questions. We'll cover the other stuff next week, whatever I couldn't cover today. There is nothing which is timely. I mean, these are the stuff which will be still applicable even if we talk next week. And then I got IBM to talk about next week. Anything else for next week? You can give me some homework. To bring up the mind the gap study, the takeaways from that, IBM, and then Cerebras IPO. I thought I'll be able to cover it today. Couldn't. These are the 3 topics I have. Fourth one, when to sell or reasons for selling. Alrighty, questions. I'll stay here for another 5 minutes.
Vivek, a couple of sessions ago, I believe the company was Hims and Hers, and you went through the checklist how to invest in the new company. Do you remember that session? I was trying to look up that session. I wanted to rewatch that session.
Hims and Hers.
Find it.
Okay,
I
hold
could
on.
be wrong. I thought it's Hims and Hers. I could be wrong.
No, I have done Hims and Hers. I remember doing Hims and Hers.
Like you went through the checklist.
Yes.
I wanted to see the checklist one more time. If you can send me the session. I couldn't find that session.
Is it 200? It is either 227 or 232. One of those, either 227 or 232.
Okay, I'll take a look at it. And if not, then I'll message you.
Yeah, it should be because I'm looking at my document and instead for Hims and Hers, it shows me these two, 227 or 232. Yeah,
Okay.
I was not bullish on Hims and Hers. I mean, they were riding the tailwind, of this whole weight loss drugs, but weight loss drugs, they're able to do it because it was on a shortage list. And I mean, my thesis is if they come out of a shortage list, what's next? I've seen many telemedicine companies come and go. So I wasn't bullish on it. I don't know how it's doing now. I don't own that stock. Any opinion on BA? Strategically important. Other than that, that is the only investing thesis. Company is in turnaround phase. The generally turnarounds take way longer, and if it is as big a ship as Boeing is, there are a lot of things to fix. So the only reason I'm still holding my BA shares, even though they are down, 50% from where I bought, is it is strategically important as a sector, and US government will do everything in its power to probably not let this company die. Now, if another US company comes in and, is able to build planes, yeah, then probably I'll invest in there, but that's my only thesis. So again, at this case, my position size is not too big, so I'm okay to just hold it. It's 227. Hims is 227. Oh, come on. No, I mean, that will be like multi bagger.
It's 20.
Oh, 20. Okay. Yeah. LMT I've not looked at, but I guess all these what do you call? Okay, let me take a note of LMT. So we can look at the financials like just we looked at Alibaba. But right now, all these defense companies are popping up higher because of the tension in the Middle East. I guess LMT also should be higher. Oh, yeah, see, Middle East these tensions can do for these defense companies. There is a defense ETF. It is IDA. It's a future cloud. I forgot, there is one defense ETF, in case if you're interested in defense. IAT, yes. Why it says the regional banks? I think it's IPA. This is aerospace defense, yeah. Again, so a lot of these defense or defense tech related are probably ripping higher. There may be a reason why Palantir is has ripped higher in last 2 weeks. Now it's above 40. Because of these tensions in Middle East. And if this subside, who knows? So like I love Palantir as a stock, but not as a business, but not as a stock price. So I think I'll have a core portfolio, which probably I'll hold. Others are getting called away. I think one is at a 45 covered call. The others are already in the money. I'm not going to defend them. Let them get called away. Cool. I guess that's it for today.
Oh, one more thing. Sorry. There is a event from the Charles Schwab next Saturday in Santa Clara. It's called the Market Drive, and they'll talk about the whole day. They're gonna talk about the market. I attended one of their session for options and the stock analysis, and that was good one. So if somebody is interested, it's next weekend, next Saturday.
Ooh. Thank you for sharing that. Alrighty. All right. Thank you for attending today. Have a great weekend. And we're going to talk again next Saturday. Nothing bad can happen in a week. Anyway, markets will do what they do. We don't have to worry about it. What happened in a week or so. Cool. Talk to you next week, guys. Bye-bye.